Thanks, Kavya. I was talking about the risk actually, and I mean, the risk did materialize, and I was trying to sort of differentiate between the risk that is there in the physical world versus the financial world. And what we realize is that what just happened about a minute ago was a risk in the physical world, which perhaps cannot be modeled. But I'm going to discuss today the risk of the financial world, which is a modelable risk. It is a risk that ex ante you sort of even ahead of it. This risk you already are aware of that it does happen once in a while. It materializes once in a while. So so what is risk? Risk intuitively we all understand the risk is about losses. It's to do with once in a while that you're invested in something and losses do materialize. But it's not about uncertainty. It's not about something that cannot be modeled. Also, the risk isn't all that bad. It is something that you get compensated for in the financial world. Okay, so in financial instruments like equity or fixed income or anything else, there is a compensation for the risk that you are taking, but only for the risk that you cannot diversify. A bit too technical here, but I'll try and explain this a little later. But in markets, be it debt or equity, you only get compensation if you're not able to diversify that particular risk. How do you measure risk? Financial participants, of course, understand the ideas of standard deviation, but intuitively we all sort of understand how risk materializes and how do we measure it. Let's say something like in equity markets, Nifty, if you're invested for about 10, 12 years, once in a decade, you will have drawdowns or losses of 40, 50%. All of them will be recouped eventually, but you will once in a decade, you will have such losses. A couple of times, you'll have 20, 25% of losses suddenly, for some or other reason. Recently we saw what happened because of COVID-19, but all of them will also recover. So in a sense, these are the risks, in some way we all understand intuitively that they do materialize at certain frequency. But because the beauty of the financial market is that this is well priced in, so you don't have to panic about it. And I think I'll get there eventually to explain as to why it's important not to panic while the risk is materializing, because this is what you had dialed for when you actually bought that particular asset. Now, let me explain this idea of risk premiums. Every time you buy an asset, be it equity, fixed income, real estate, there is a risk premium which is attached to this particular risk that you are buying. I mean, globally, let's say if you're buying a S&P 500, which is an American equity market, you're likely to get about 6.5% or extra over and above, what you would sort of get in fixed income. Now, in India's case, unfortunately, the risk premiums have not been very high, but equity would still dominate, would stay sort of right at the top in terms of the kind of returns that you would earn if you're invested for long enough. So that extra return that you're getting in equity is the risk premium. The extra return that you're getting in fixed income fund is a risk premium over fixed deposits. Now, why are there risk premiums? Because majority of us are actually averse to take any risk, and which is why the very relatively smaller capital is available to invest in riskier asset classes, and which is why it demands for certain premium. But please understand this, that not taking a risk is also a risk. Because at all point in time, inflation and tax, these are the two demons who are actually eating your capital all the time. So it is important that sort of look out of fixed deposits and treasury bills and gilt securities and dial some risk so that you get the risk premium and hide yourself from taxes as well as from inflation. Also, sort of a small minute explanation of who seeks risk and who does not. We sort of today know this, a lot of studies have happened that the youth is able to take more risk than, relatively older people, which is why, the big firms, the trading firms, do tend to employ young people as traders or fund managers, who sort of are trading actively. Older people tend to get risk averse. Also, the females are somewhat risk averse than males, especially the younger ones, because the older ones, all of them get risk averse. And finally, the richer people tend to take risk more than the poorer people. This audience that I'm talking to today, these are, you guys are sort of 1%ers or perhaps 0.1%ers of the society. You are here and you made money and you are interested in understanding where to sort of invest your money is because, and you are rich, of course, is because you've taken risk in the market in the past. You've taken risk in your life in the past, and which is why you are rich. So, that's the characteristic of risk, that only rich relatively sort of are ready to sort of dial risk. And that also is one of the reason, why you become rich versus, a larger section of society. But let me explain something more fundamental, something more what is applicable to, what do you call it, debt and equity funds. In 2-3 minutes, I'll try and explain the variety of mutual funds, especially on the debt side, how and what kind of returns and risks they do produce over long periods of time. So what we did, only for this conference, what I did was I put together top 5 fund houses, guild funds, income funds, credit funds, and actually looked at their performance over last 20 years as to how they've delivered. Now, left side of the chart, look at the guild fund. Okay, guild fund, this is an annual return of guild fund on a daily basis whenever you invested in from 1999 to date, okay, till yesterday. This is the return profile of a guild fund, which has sort of mostly has hovered around, somewhere between, it goes all the way to 20-25%, also sort of goes to zero, and sometimes actually the risk materializes even in a guild fund and it delivers, let's say, -7, -8% return as it did in 2009. So, okay, so what you will think actually that government security, how could there be any risk? But the reality is that on the left side, when you see the chart, the risk does materialize for this fund also. It does deliver negative returns also. But then look at the small table beneath this chart. Okay, on an average, over 20 years, the fund category is actually delivered about 10 quarter of return with a standard deviation of 6.5%. So what does it mean? Basically, a big picture idea. Okay, this is absolutely not the clear math, but big picture is that the returns mostly have been hovering around 3% to 17%. Okay, so it's a very wide range if you invest in a guild fund. So a thing that you actually at the onset thought as something completely risk-free is a very, very relatively risky asset class, especially if you compare it with fixed deposit. But there is a trick here. You can actually invest instead of in a guild fund instead of 1 year. Look at the right side. If you invest in a guild fund for 3 years, suddenly these spikes actually go away and you have a relatively stable pattern of return. Look at this now. For 3 years on an average, you've sort of earned about 980 a return. Median return has been 870. But look at the standard deviation has actually fallen by more than 50%. It's only about 4.5% now. So basically, 2 points we understand here. Even the government security, which is appearing a bit of a risk-free in our mind, because there is a lot of market risk in it, it does materialize. But by elongating your duration in a guild fund, of course, you actually can reduce the risk. But there's a small point I want to make here. A lot of people will actually get enamored with the returns here. Look at this on the left side. The returns are near 14-15% for last 1 year. Don't expect this return to have a rerun. Okay. So what has happened in the past is not what's the promise of future. It is very likely the returns would actually do a deep dive because the rates have already come down. So I'm giving my view here. Be careful of this category incrementally. It's not going to sort of have a great run that it has had in the recent past. Quickly, another fund category, which is income fund, it's actually somewhat less volatile. Look at this. This is also investing in long bonds, which is mostly AAA, and actually delivers somewhat better returns than what do you call it, guild fund, about 40-50 basis point better returns than guild fund, and has a lower standard deviation than guild fund. So basically, this actually asset class appears to be relatively less risky. But what is the risk that we dialed here that actually did not, market risk did materialize many times? Look at this on the left side. Many times returns are going to near zero, many times over last 20 years, okay, 25 years actually. But they also go all the way to 20% also. Okay, average they delivered about 10%, a standard deviation of 5%. What does 5% standard deviation broadly means? That the range of return is going to be somewhere between 5 to 15%. Okay, same point here on the right side. elongate your duration and actually standard deviation, the risk actually comes off. Okay. So 2 points here. One, that it somehow is producing a better return profile than gilt. Okay. But yet I have to tell you here that because it is investing in AAA securities, generally because they are PSU centric, the risk never materializes, and which is why it induces lower vol with lower volatility by higher return. But you also remember this, that what happened in last 2-3 years, a lot of companies which were AAA, Dewan Housing, INFS, they all went down. The good news is that majority of mutual funds actually don't invest in such securities, and predominantly they are in PSU bonds, and which is why you can look at this category somewhat safely, okay, without bothering about defaults here. But then let's talk about defaults. One fund category which has been hammered badly is the credit fund. How risky are they? First of all, look at on the left side. This is the annual return of credit funds of the top five, including one of Birla here. Okay, over last 17, 18 years. I have to tell you this, the first 5-7 years are actually only one fund house, who used to run a credit fund. And after that, about 5-6 funds are there. Now, the good news here is that the risk of this category is substantially smaller and lower than actually gilt fund. Also, on a 3-year basis, this has been a remarkably consistent fund. Can I continue, guys? Because I hear many other people. So the credit fund, okay, I'm hoping I can continue and people can listen to me. The credit fund, actually, the standard deviation is actually quite like a fixed deposit. On an average, they've delivered about 8.5% in last many, many years. Yes, it's been a very bad 1.5 year. But remember this, that relative to gilt fund and income fund, they are relatively less risky, okay, than gilt and income. Gilt and income, many times they've delivered negative or zero returns. That's not happened in the credit risk category. Quickly, a very, very different fund, which is low duration. Here in this fund, look at the return profile of this on the left side. It's been remarkably consistent and somewhat flatter, almost like a fixed deposit. An average last 20-22 years of 8% return with a standard deviation of just 1.7 year, which is very much like fixed deposit. I'll show you in a while. Okay. Again, if you sort of elongate your duration, your returns actually does not go down. It's somewhat closer to what you have for 1 year. So in a sense, it is a fund, which you could potentially invest for 1 year, 2 year, 3 year without bothering about a lot of drawdowns. Why is it sort of expressing itself in this manner? Because it does not take a lot of duration risk like income fund and gilt fund, and which is perhaps why that, over long periods of time, this actually exhibits a behavior of a fixed deposit. Okay. Now, finally, one more fund category. So we've talked about gilt and income, which are market-oriented products and risky. We've talked about credit fund, which are assumed to be very risky, but whose risk is actually lesser than that of gilt and income in terms of how they've played out over the last couple of years. We talked about low duration, which is very much a replica of, what fixed deposit does, but of course with a lot of liquidity and tax incentives. And finally, the liquid fund is the pure good. Its returns are not materially lower than what you call fixed deposits over the last 15-20 years. And its standard deviation, its risk is actually lower than fixed deposit. Okay, so it is remarkably consistent, very low volatility, and a very good product, even for a retail investor to sort of invest in. Let me spend a minute on sort of equity. Now, on the left side, what you see in equity is an annual returns of equity of last 25 years. What you see on many, many times, in many instances when the returns are actually negative. Look at here on the table beneath. The average returns of equity is about 13.5% in last 25 years, with a standard deviation of 26%. So on any day, in an annual terms, the returns could be in the range of -15 to +40%. So in a sense, a very, very wide range. So as I told you in the beginning, that intuitive way to understand risk is actually that how many times you've lost money. Almost 25-27% of the times that you're invested in Nifty for 1 year, you would actually lose money. But if you make it a longer horizon, as I've done on the right side here, again, the same standard, 3-year annualized returns of Nifty, of course, the number of instances that you lose money actually come down by half. If you make it 5 year, then only 5-6% of times you lose money. So again, just keep this in mind that if you are investing in equity, do not invest for 1 year, 2 year. It has to be, you have to be there for longer stay. So the only fund that, so far we've understood, you can invest for just 1 year, 1.5 year is low duration and liquid fund. Something like Nifty, Gilt, income fund have to be for longer term. I think the equity funds have to be for 5-year minimum. Okay, a quick one here is how does the fixed deposits sort of compare with market products? Okay, so I have 4 indices here. What I've done is that, over last 20-21 years, I've taken up very big banks with the top 5 banks fixed deposit rates and actually made an index of it. That's the green line here. You can't even potentially see here the one which is beneath. And there is another violet line which is the low duration fund. So what is it telling you? That low duration and the FD index actually move mostly in tandem. Gilt fund actually delivers better over last 20 years, and actually Nifty delivers even better. So essentially the key thing is that, any of the market product that you're dialing in, you of course are taking some risk, but there is some compensation that you're getting, and which is the way you get sort of richer eventually, because, your portfolios have to make more return for yourself. A quick one on comparison of fixed deposit versus low duration. I want to emphasize here for a few investors, who want to be in a fixed income. There's a lot of craze for banking, PSU, corporate bond fund. I think given that interest rates have already come off a lot, I think it makes sense for investors to be in low duration, especially, in times when returns are very low already. Returns are not going to be very high in these funds, but they are most probably going to be better than fixed deposit. Look at the comparison of fixed deposits and low duration fund. On an average, over last 15-17 years, more or less both the funds have delivered exactly the same return, okay, with similar risk profile. But of course, in low duration fund, what you get extra is actually the liquidity and the tax incentives if you stay invested for 3 years. So I think at this point in time, it makes sense to be in low duration. But at all point in time, market-oriented products would actually do better than fixed deposit. Now I want to make a small point here, okay, and which is where the idea of an advisor comes in. Okay, we all want that. Okay, can we go directly to the funds, and because you get the same sort of brokerage. But the point is, right now I want to sort of spend a minute on this, that across the fund categories, be it from balanced fund to liquid to gilt, that there is a difference between a top quartile fund and a bottom quartile fund. The ones who are doing very well and the ones who are doing very bad. Okay, the difference is huge. On an average, the equity funds deliver about, bottom quartile funds deliver about 4% lower than the top quartile funds. Okay, so that's huge. In basically in 20 years time, the guy who's invested in top quartile will be twice richer than bottom quartile. The similar number for the debt is about 1%. Okay, the top quartile funds deliver about a percentage more than the bottom quartile funds. Okay, so again, both for fixed income and equity, it's important that you have a friend or you have an advisor who can suggest that which fund to sort of invest in. Now, the small point here, on the credit funds, I made a point earlier that they have been remarkably consistent and they've done very well. But the crazy thing about credit fund is that it doesn't have a lot of history. But more importantly, in last 5-7 years, the difference between the top quartile fund and the bottom quartile fund turned out to be almost 8%. Now, that's too large for an investor to digest, and which is why it's on the industries to sort of rebuild this category, and so that this deviation can actually come down. It's far too much for a fixed income and far too much for an investor to absorb this kind of a differential of return between a good and a bad fund. Finally, this is my last slide, and I want to sort of suggest how to reduce risk. Okay, these are not theories. This is what I have developed for myself as an investor. Okay, I told you in the beginning that you only get compensation for the risk that you cannot diversify. But if you can diversify, you must diversify that risk. Okay, so any unique risk that you take, okay, you put all your money because of fund, you like a fund manager, or you put all your money in a small plot because your friend told you that okay, that plot is going to sort of double or triple, or you do something crazy which without diversifying, you are running a big risk for yourself. So number one tenet of reducing the risk is diversify. Whatever that we all tell you, at least even across fund houses, diversify 5, 6, 7 funds, that you must pick, just to ensure that no unique risk plays out. Number two is that you must rebalance. Okay. And what does rebalancing mean? Is that whenever the markets are super hot, don't give in to this idea that time versus timing, because that's not played out. Okay. You have to be able to rebalance your portfolio, sometimes in favor of fixed income because equities have done too well, sometimes in favor of equity, like recently what you should have done or what you should still do because equity has done badly over the last 10, 15 years. Okay. So even asset managers, someone who is not doing very well, you have to be able to balance, and which is why a good advisor would actually come to rescue. The third point is that you must avoid the risk of ruins. Okay. Now, this is a very, very big risk. Many people want to buy penny stocks because, someone tells them that they'll double or triple. They want to buy just one fund because, you heard from a fund manager that he's the greatest of all. Now, this exposes you to ruin because, if anything which is, not diversified and too concentrated, again, I'm repeating the point, but somewhat different here. Be careful of risk of ruin. Always diversify. Don't give in to, ideas which seem idiosyncratic. Finally, don't panic, okay? Because as I told you, the important thing to keep in mind is that pretty much all financial markets bake in, what do you call it, risk. And therefore, if you stay invested and if you don't buy assets at crazy prices, most probably you'll get compensated. But precisely when everyone is panicking, biologically, when we want to run, those are the bad times to run away from fund. Be it sort of running away from credit funds in May or running away from equity in March. So don't just panic. Be careful, and which is why again a good friend or advisor comes in picture. Be careful of panicking. As I said, have a friend who knows how to avoid bad funds. I've talked about this in a minute ago, that a bad fund on equity side actually does worse than a good fixed income fund. So ensure that you have some friend who can tell you that, you avoid what you call bad funds. So, okay, so this is where I'll stop, and let's see if we have some questions.
Yeah, hi, Maneesh. That was very, very interesting. And in fact, I heard this thing, risk of ruins. What was that?
I was read sort of. I don't know whether it does. This thing comes in. A lot of it comes in psychology. The ruin is essentially that when you bet a lot of money on some intuitive idea which is too concentrated, and let's say when you go for gambling, okay, you as a trader or as a bettor, you don't bet on one pot, too much, because you must survive so that tomorrow again you can bet. So that's the risk of
don't bet the house, as they say.
Don't bet the house.
Okay, fantastic. Now, Manish, I will ask you. I'm laying out a trap for you. I want you to recommend a debt category for 6 months, 1 year, 3 year, 5 years.
So 6 months, 1 year, I think is low duration. Okay, I try to explain. I'll share this presentation that people should sort of simply look at this. It's a pure good. It does a good job of replicating fixed deposit. For 3 year, I think short-term funds are good. And for 5 year, also I have to tell you that I'm not going to recommend anything else but short-term fund because rates have actually come off, and this is a bit of a view part. We don't think that interest rates can go down dramatically from here. So I don't think investors should dial a lot of risk now by dialing income fund or gilt fund now.
Okay. Now, finally, a lot of people are asking for your view on banking and PSU funds.
So my suggestion to people will be that instead buy short-term fund. We also run a very large banking PSU, and industry is very big. But see, there has been a chase for banking PSU, and which is why the spreads have come off dramatically. So over next 3-5 years, your return experience in banking PSU, it would not be very volatile, but it would be sort of lowish 5 to 6%, I think. So, I think you're better off buying more multifaceted, short-term fund, which sometimes invest in AA plus instead of simply focusing on PSU bonds.
Thank you, Maneesh. You've been very forthright. You've been very clear. You've been very cogent. Thank you for being with us today.
Thank you.
Okay.